afternoon, dear members of the Swiss Chamber, and good afternoon as well, dear members of the Swiss Thai Chamber of Thailand. Warm welcome to the first event we can conduct together, the Economic Outlook 2022. It's just the beginning of the year, and I'm very happy to host for you today's outlook and today's talk about the economy and what we can expect that year. My name is Georg von Wattenwyl, and I'm your chairman of the Swiss Chamber in Singapore. Please let me welcome as well our great panel of experts today. We will start with a presentation about the most recent numbers and as well an outlook about the economic with Rajeev de Mello. You know him already. We already had some events together with him. He's a great expert and managing partner of Gamma Asset Management, and he will share his views to warm up a bit with a presentation. And then afterwards, we will have a panel discussion with the experts. First of all, Marco Huwiler, who is the head of the Singapore branch of the Swiss National Bank. We have Hartmut Issel, who is managing director and head of the APAC equity and credit, global credit from UBS Wealth Management. And we have Mark Matthews, who is the head of APAC research of Julius Baer. So a great panel, which we can talk about a couple of trends, couple of interesting outlooks, and as well hoping to give you a lot of good insights how you can plan maybe a little bit when it comes to some parts of the economy, markets, and maybe as well investments. I will moderate, and I will please just come with your questions. You can always bring up your question as a chat, and then I will moderate the question and make sure that you get as most as possible answers so that you get a good view of the economy 2022. Interestingly enough, so when we just check the study of Bloomberg, who analyzed many of these investment outlooks and investment reports in the beginning of the year. So there was 46 institutes which provided their update, and one interesting observation was that if you just check and realize for which word is the most used and the most commented, was this year inflation with 224 times mentioned, and as a reference, only 36 times all these reports are mentioning the word COVID. So maybe that shows as well that we are going into a new regime. I'm sure we will hear a lot of that, and I think time-wise we couldn't be better. So after we had this week already the MIS here in Singapore, who tightened a bit the interest rate because of outlook of inflation, and now yesterday as well with the Fed, who also gave an outlook for 2022 interest rate policy, and it was pretty interesting to hear all these comments, which also goes in a direction that probably interest rates will go a bit higher this year. However, so now I would like to hand over to Rajeev so that you can share a bit your thoughts to warm up in the next 20 minutes, and then afterwards we will open the panel for discussion. So please, Rajeev, stage is yours.
Georg, thank you so much for the introduction and the introduction to the subject, and I'm very thankful to all the other panelists and also to the audience, especially to join us at this beginning of the year. As Georg mentioned, we I really think we couldn't be more timely in terms of major events around the world. Georg mentioned a few, the Fed, MES in Singapore. We have also the situation in the Ukraine as well. Quite a lot of different events. And I think myself, and I also speak on the behalf of the other panelists, we're all very excited to join today to share our views and to exchange views with you and answer questions. So I will have a small, short presentation, 15 to 20 minutes, where I wanted to talk about the big questions that I find are important for 2022. And one of them is, of course, this recovery, the post-COVID recovery. Where are we? Another one is the policy. So we mentioned briefly the Fed, but will policymakers generally around the world help or hinder this recovery? Talk about financial markets, and also talk about China and why China is struggling, and then end with impact on Singapore and on the rest of Asia. So those are really the big topics we wanted to talk about. But then, of course, the panel is exactly there to answer your questions and also to share different views and perspectives between us. So I will start with the presentation. I'm just going to put it on, and hopefully it's clear on the screen. Do we see the slides? Good. So
it's all clear.
I've put these big questions up. I mentioned them. Let's start with where we are in terms of the post-COVID recovery. So if we look at this chart, which shows global GDP by quarter, we see that the whole pandemic had just an incredible impact on growth. I think all of us felt it personally in our business lives as well, and in what was going around. It was far worse for that one quarter than it was during the global financial crisis. But then we also had this incredible recovery last year, and then the stabilization as we see. And right now we saw in the third quarter of last year, because this data is slightly delayed, a stabilization, a slight increase. And the IMF for 2022 is calling for 4.4% global growth, which puts us back almost at the levels that we were before this whole thing started. Now, what is positive for the economy is really that we're seeing a decline of the very negative impacts of COVID on health first, and we see in this chart the decline in actual deaths. While the case numbers have been going up and down with Delta and now with Omicron, the good thing is that many more people are vaccinated, and the impact on health, even if people go to the hospitals, and there is that worry, generally the most severe impact on health is really much smaller than it was before. And so there is hope that this wave of Omicron might get people a bit sick, but not overwhelm the system. And so we can keep up the opening process that has been going on now for the better part of last year, since we have started the vaccination campaign. Now, if we turn to what companies are thinking, companies are still optimistic, and this chart shows, a survey of businesses, the Purchasing Managers Survey. It's a good survey because we can compare it across countries. And here I show the major regions of the world: the US, China in red, Eurozone, and Germany as well. And we see there's a bit of a moderation in the optimism. So after really a phase of pessimism after March 2020, we had a huge surge in optimism, and that's moderating somewhat, but still remaining quite positive when one compares it against a baseline where it's roughly around 50%. That's the way this index is built. If it's above, it's somewhat positive, and if it's below, it's pessimistic. So businesses are more optimistic. And I hope that's something that that you are feeling as well in your businesses. Now, when we look at growth and growth expectations, there we see that growth really surged, and this is a kind of index here. It's interesting because this is looking just in 21, so it's a much shorter snapshot of economic indicators in the major economies around the world. And what we see is that there is a moderation in expectations and a moderation in actual growth. From that very high boom level, I would say it's a bit of a normalization in growth, still positive, but at a growth level which is more subdued than what we saw in 2021. That change in some areas can have an impact, and we'll go into that in a bit more detail. Now, what we see is a similar chart looking at inflation. And as Georg mentioned, there's a lot of concern about what's going on in the inflation front. And this index as well looks at inflation across the US, Europe, and China compared to an average, and a consensus inflation expectations as well in the dotted line. And we see that that's gone up. Surprises in inflation have gone up in the US and Europe. In China, that's remained very low. But in the US and Europe, we've really had quite an increase in inflation. And in many countries as well, including Singapore, as we saw this Monday, CPI number came out high, 4%. So there is a worry about inflation. Some of the factors are global. Commodity prices have gone up, and others are more local. Now, the worry is it short-term inflation or is it long-term? So let's have a look at this in this next slide. Here, what we see is a breakdown. So we've had a big dislocation in prices due to the pandemic. And some of these prices are temporary, and some of them seem to be more persistent. And that was one of the answers that Chairman Powell had to give yesterday in his press conference. So on the short term, we have supply bottlenecks, which are really a problem. Of course, the most visual one was really when that huge container ship got blocked in the Suez Canal. And there was a problem of supply, but many ports in China have been closed due to COVID. Los Angeles, Long Beach, the biggest port in the US, also the big backlog. So we had these bottlenecks of supply, which drove up some prices, and that's coming off. It's less of a factor, but we have many short-term factors that are pushing prices higher, such as that fiscal stimulus, which was very strong last year. It's moderating this year, but it's still very strong. House prices, which are going up, and we see that in Singapore, we see that in Switzerland, we see that everywhere. And also the fact that employment is going up and wages are rising. We can see that also everywhere with shortages in labor of all kinds. In the long term, we do have many factors which continue to push prices down. That hasn't changed from the last 10 years. Those continue. High levels of government debt, IT, technology, which are offering us cheaper services, and an aging population also, which puts downward pressure on inflation. Central banks, however, in the long term, are more aggressive in pushing inflation higher. They're targeting something around 2%, whether it's in Japan, whether it's in Europe or in the US. Central banks have indicated they want to see inflation higher than the levels of the last 10 years. Of course, now it might have gotten too high for many countries, but still, Bank of Japan's governor in a speech day before yesterday mentioned that he would like to see inflation in Japan rise more. And then we have some problems which are linked to the central bank actions, which have accumulated huge amounts of government bonds. So there's a certain problem coming from that side, and very, very low real interest rates, or very negative real interest rates. When you take an interest rate minus inflation, that's also could push prices higher. And the cost of implementing many solutions to climate change can also be expensive and a cause for higher inflation. We're seeing that in the short term with higher oil prices. But let's turn to central banks. Here we see the balance sheets of central banks measured in dollars. We can see Japan at the bottom, it's increased its balance sheet. China, slightly increased. ECB, quite a big jump in blue. And the Fed also quite a significant jump over the last 2 years. But what we're seeing is that there's a plateauing out of that rise in balance sheets. Now, if we look at the central banks as a share of their GDP, what we see here is also this growth, but we see right on top, Swiss National Bank, of course, having reached quite a high level of assets compared to GDP. We see the other central banks as well, all rising in terms of GDP, except for China, where we are seeing a gradual decrease in asset in the balance sheet compared to GDP. Now, for the economy and for financial markets more specifically, it's the change in this increase in liquidity, part of which comes from the balance sheet, part of it comes from interest rates and other currency policies as well, which is most important. And here in this chart, we see that there's these swings in liquidity. And more recently, we've seen it's a beginning of a decline in liquidity. And that's something which is we can see already impacting financial markets. Now, financial markets, just to show the size, have really ballooned the value of financial assets here. And here we show all the different components, bonds, equities, gold, all of that has gone up quite significantly, which is also one of probably the concerns of central banks, even though they're not very clear about expressing that concern. But what we are seeing is that because of their signaling, global bond yields have started to increase. And this chart shows since 2007, US yields from the short term, the Fed funds rate in yellow, that hasn't gone up yet, but Chairman Powell indicated he was going to increase it in March. To the 2-year, which anticipates rate increases, it has gone up, and this was printed last week. It's gone up even more. And all the other parts of the US curve, we're seeing a rise in yields. Not only in the US, but in this chart, we also see that that rise in yields is going up in most countries as well. Now, world stock markets are not showing any signs of concern. And here I flip to what's happening in the markets. We had a bit of a downdraft or a downdraft since January. For a month, the fall has been, very pronounced. One can see it in the last indication of this chart, but even yesterday night and this morning, we're seeing a further fall. But we're starting from a very high level on equity markets. And so, on the one side, we could say, well, it's already very buoyant. It would be normal for them to come down a bit. They had a very steep increase in value since March 20 or April 2020. It's an unprecedented rise. It would be normal for them to come down a bit. But on the other side, we know that financial markets are also important for the economy. And the too fast a correction often causes further problems elsewhere. And we saw that in 2000. We've seen that in the global financial crisis. The financial system can contaminate the real economy. So that's a worry. The question was asked to Chairman Powell yesterday, and he basically dismissed his concerns about financial markets instability, which sent markets further down after that comment. Now, on the dollar side, what we can see also is the dollar is expensive compared to its history. Here we're showing dollar against a broad number of trading partners. And so we can be a bit worried about the dollar, but the problem is that the US is ahead in terms of increasing interest rates. And so the dollar tends to be supported by that factor as well. You're getting a bit more yield in the US than in Europe, than in Switzerland, and in Japan. Other emerging markets are also increasing their interest rates in pace with the dollar because of the strong dollar and their currencies being weak. So the dollar has an impact, not only on the currency side, but also on what other central banks have to do. Now, turning to China, Chinese businesses are slightly more optimistic. Here we see the profile since 2019, of course, the dip when COVID hit China, and then the recovery. And then a period of time when the economy has been weakening in China as policy has been tight, and also the zero COVID policy also did not give too much confidence to businesses. People locked down. We can still see that in Xi'an and Tianjin as well. But now we're seeing a little bit of a more optimistic view within the Chinese businesses. Now let's turn to Singapore. Here we see that Singapore has generally been stable. I'm comparing Singapore in black against China that we just saw, but I'm also showing South Korea. We had quite a move down and up, all these countries in 2020, stabilization and now a slight improvement as well. So cause for some optimism in terms of the economic cycle, but some worry on the financial side. So just in summary, before going to the panel, where are we in terms of the post-COVID recovery? We're still growing. The global economy is growing, but it's moderating after a strong 2021, and it will continue to moderate. Policymakers, will they help or hinder? Central banks increasing interest rates and governments are slowing their fiscal stimulus. So they're really hindering the recovery. They're slowing it down. Can financial markets continue to perform as they did in 2021? Probably not. They're being affected right now by their high valuations in terms of a starting point, and by a tighter monetary policy and announcements about further tightening in monetary policy. Why is China struggling? China has been, watched carefully for slowing growth. Relatively high interest rates in China, which only now are being cut somewhat. A zero COVID policy and a struggling property sector, which has really been very difficult for China, partly due to policy to reduce the speculation in the property sector. And finally, what's the impact on Asia and Singapore? Asia is benefiting from a stronger global recovery. That's very important for a lot of Asian exporters. It's suffering from Chinese growth, which hasn't yet picked up, though there is some optimism. And many Asian countries are suffering from weak global tourism. And that's something which continues to be a problem. And though we're optimistic that things will open, I have been optimistic before, and it hasn't really panned out. So with that, I will end my presentation here. There are a few additional slides that we'll send out to you after this call, and turn it back to Georg.
Thank you very much, Rajeev, for that presentation and your thoughts, which we certainly, the one or the other, are going to challenge now together in the panel. But here again, please, dear audience, so feel free to bring up your questions as well, or the topics which you are maybe interested. I know we are very diverse, so there are people from investment markets, but there are as well companies which maybe has to take some decision. Is it the right time maybe to hedge or to fix some prices when it comes to energy, or what does it mean in terms of interest rates? Will interest rates go up further? How much is the market already escalating? And on the other hand as well, certainly some investment topics. So I think I want to skip a little bit on the inflation topic, because I think that is something which now everybody's talking about, and obviously, and even though everybody knew that will come once in a while, with so much money in the system that central banks has to give a bit of turn there. It's interesting that everybody's pretty surprised and a bit concerned as well. And maybe that comes as well because it looks like it is a bit different to understand this kind of inflation we are in. Inflation on one way means and money has less value. If I want to buy something, things are just getting more expensive, but I'm not getting more. It's not really helping the economy. But as we just heard as well, so there is also inflation which is produced by investments. So ESG, as you mentioned, for example, obviously there are some some investment and into the infrastructure which are coming along, and obviously the market will be ready to pay as well for that, and that's something maybe where an economy as well can benefit from it. And there are just situations which we hear all around, like for example, when it comes to the supply chain of chip industry, inventories and so on, which make things more expensive, oil prices which is going up. So there are a couple of aspects in, and obviously that is something which the market is a bit concerned, and as well with how can we get these things under control, and this inflation then really coming down a bit. So I want to open maybe that question a bit to the panel, and maybe hear a bit further thoughts. And I would maybe start with our Swiss National Bank representative, Marco. So how do you look at that topic? Actually, I'm sure that in your institute you are discussing a lot about that.
Mm-hmm. Okay, thank you, Georg, for the introduction, and as well, Rajeev, for this very interesting presentation that covers a lot of the topics. And also, I thought what you said about inflation was very accurate. I think it's important to understand where we are coming from. So in 2020, we had the pandemic shock, and some prices went down, and now, as you showed last year, we had this recovery. Consumer prices went up, and this created a high inflation. Now, together with continued increases in oil prices and the bottlenecks, this has pushed inflation up in many economies, and up above the target of the central bank in the economy. Switzerland is maybe an exception, where inflation is still below 2%. So these factors currently driving inflation should wane in the medium term. That's the opinion we have, and hence inflation should decline to a more moderate level in the course of this year. So the bottlenecks you mentioned, they should gradually ease, and the strong demand in the wake of the economic reopening should subside again. There should also be a shift in demand back from goods to services. This is something that is also interesting because of the lockdowns. Restaurants were closed, cinemas were closed, and so on. You couldn't go on holidays. So there was this shift to goods that created strong demand on the side of goods, and this should also normalize in the months or quarters to come. And finally, the recovery of prices, which fell sharply during the pandemic, should come to an end. So the moderation in prices or inflation is somewhat delayed. And that's what you mentioned, Georg. It's maybe was anticipated to happen earlier, maybe last year. And this is delayed to the still high oil price. We all know oil prices are still going up and not coming down that much. And the supply chain disruptions are ongoing as well, causing imbalances between the supply side and demand. So as soon as these effects subside in the coming quarters, inflation should decline. However, central banks must remain vigilant, because this scenario is fraught with uncertainty. Supply chain disruptions could last even longer, as we've seen last year. And this, combined with continued strong demand, could lead to further inflationary pressure. And inflation could, this is also a downside scenario, become broad-based. So this is a bit my view. I also would like to say that central banks have the necessary tools to tighten monetary policy should inflation pick up more strongly in the medium term. And as you mentioned, the Fed is one of the central banks that is now preparing for a first rate hike. That was my takeaway from yesterday's press conference soon, as they say. And other central banks have already increased rates, by the way, like the Bank of England or the Norwegian central banks, and others like the Bank of Canada is also preparing markets for the first rate hike soon. So that's a bit my view on inflation. And yeah, back to you, Georg.
Yeah. So there are a couple of measures in place, and looks like we get inflation under control then a bit later. Is everybody agree with that, or is there?
Can I just ask you a question about the wage inflation?
Mm-hmm.
You didn't talk about that too much, but that's an additional source of concern.
Actually, Rajeev, I pretty much agree. By the way, hello, friends from the SwissCham. First of all, also very happy to be back. So happy that actually I'm already a bit prematurely putting on my auspicious clothes ahead of the new year. But on a more serious note, so I would allow us to take a step back here. I don't know, maybe Mark can also share a bit what investors at Julius Baer have told us. But about 9 months ago, right, there wasn't that much sign of inflation yet. But the 10-year, I remember, right, was barely creeping over 1%. So our 2% and higher inflation forecast at the time, we got a lot of pushback, right? Where would so much inflation come from, right? How can we possibly be even close to 2% on the 10-year, right? And now the narrative is completely on the other foot. Now we're getting asked, oh, you know, how can you be so dovish, right? I mean, don't you see all that inflation? And yes, I would agree with Rajeev, right? We need to take inflation apart and maybe divide it. I think that's useful into two buckets. Yeah, so one is the goods one, to some extent energy that even flows into the core inflation. And here what we see is if we look, you know, any sort of early indicators, that be it month-on-month indications, which haven't really gone up anymore. I mean, they're still high, don't get me wrong, but they're not as high as they were in summer. You look at ISM paid prices, yes, it's still about 50 quite a bit, right? But it's not 90 anymore. So these things are already coming down. And right, just to illustrate this point a bit, if oil goes from $10 to 80, that gives you a big contribution to inflation, right? If it goes from 80 to 90, which it may well, or even to 100, right, your contribution becomes smaller. So I think the goods part, that is relatively well predictable in a sense that, yes, it has to moderate, we think, latest in 2-3 months or so. The wage side, and therefore also services, we heard about this linked to it, is a bit trickier and potentially also a bit stickier. I would say that, right? So also in many parts of the world, the unions are just starting to prepare for wage increases. However, you know, if you just do the math, right? So if the goods part of the inflation comes down, so even if wage inflation remains here or even goes a bit higher, which, you know, we cannot completely rule out, but sort of just mathematically, it still would imply to us that inflation has to ease a bit, and probably we don't have to wait for too long. Just also to illustrate that viewpoint.
Georg, may I chime in and add my 2 cents to the conversation? And
Absolutely.
I've enjoyed listening to what everybody's had to say, Marcus and Hartmut, and of course Rajeev, and just trying to think of what else I can say. And what I thought of when I was listening to them is that nobody talks about COVID anymore. And before you opened up to the audience, we were chatting, and I think you mentioned that you'd read somewhere, Georg, that there was a word count done of stories in the newspapers, and it's all inflation and not much COVID. But to me, the root cause of the inflation is COVID on multiple fronts. I mean, number one, the stimulus, both fiscal and monetary. And so Marco mentioned how there was an explosion in demand for goods and demand for supply services collapsed. And at the same time, the monetary stimulus, of course, drove interest rates so low, and that's what made property prices go up. And big private equity companies have been going up, buying all the properties in the US. You know, the inventory is a quarter what it was 5 years ago of residential property, because they're borrowing cheap and they can buy these properties and rent them out to people. So there's a scarcity of property. And then then, you know, all the people who've left work because of COVID, 3 million baby boomers retired. There's probably 2 million less working age immigrants in America than there would have been had the borders not been closed. And as we speak, I just read the Census Bureau did a survey, and they found there's currently about 9 million Americans who are on sick leave in America because they got COVID or they're looking after somebody with COVID. And I shouldn't laugh, but I'm trying to make that point to go to what I want to say, which is that if you believe it is becoming endemic, and I think all the signs are there that it is, and the immunologists and virologists and other specialists that agree with that, then naturally this inflation should fade away, because all of the things that I just mentioned should also fade away. You know, the people should start going back to work, and the borders should reopen, and et cetera. But the big thing that I just want to leave with as a risk is that the politicians have invested so much money in COVID. I'm just worried about how they're able to disassociate themselves from all the rules and regulations they've put in place. And I'll give one example, which is that as of the weekend, truckers coming into the United States from Canada and Mexico must be vaccinated. Well, the problem is truckers are stubborn people. 2/3 of them aren't vaccinated. So this is just like one little example of how I'm a little worried that the politics might hold up the resolution of the inflation issue. And then there's the other thing that I'll just throw in the pot, which is Ukraine. No one knows what's going to happen. But in the event of outright armed conflict, I think that oil could easily go above 100. So that would make it difficult for the inflation rate to come down. So I want to be in the inflation is going to come down camp, and I can see all the reasons why it should. But I also see some political hurdles or perhaps hiccups that could occur on the way. And in between now and the summer, which is when I do expect inflation to normalize, we're in this sort of vacuum where we've got the Fed that's turned a lot more hawkish.
Thank you very much, Matthew, for this view. I think that's you explain exactly why that topic is so complicated at the moment, and maybe as well why the market is reacting such uncertain actually, and we see that today as well again on the investment markets and so on. The volatility is just here. But you mentioned also something which I think we should as well a bit pinpoint. It's about the value stream. It's about the goods, the chain of the goods from one place to the other, the shipments and so on. So post-COVID, so we know everything is getting more complex, everything is getting more complicated. That has an effect on costs as well, and then on the prices for goods. So what do you propose to our members and to the companies? How should they position themselves actually in this environment? Is that getting better in future, or do we get that under control, or will it even be tougher? So I just remember we had this week, I think, a US official who warned really about the inventory who falls to I think 5 days or something, which usually is about 10 times higher in normal times. So that means it gets more difficult to do business, right?
I'll briefly give you my opinion, and then I'll ask Rajeev and Hartmut and Marco to do the same. No capacity was destroyed by COVID. It's not like we had a war or an earthquake or something like that. All the car factories, all the chip factories, they're all still there. To me, it's a human capital problem. And so to come back what I said earlier, I mean, if 6 months from now, everybody still has to do a PCR test before they get on a plane, and you have to be vaccinated to cross the US-Canada border, then I'm afraid these supply chains could be still quite hamstrung. And so much actually does, in my humble opinion, still depend on the trajectory of this wily virus.
Rajeev?
Yeah, on the inventories, what we have seen in the last pieces of data is that companies are rebuilding inventories now. I noted with shock that statistic about the semiconductors. And I think that that is something which really plagued the auto industry last year, with car prices going up, new and used as well, and contributed to inflation. However, I do think that there's a response now. And the inventory data, which was published in the United States, shows that companies are building back inventory. And in these inventory cycles, what could even happen is that everybody's very prudent and increases the inventories considerably. Semiconductor fabs are being built. They take a while to produce, but there's a lot of investment going into that type of inventory as well. So I think that, yes, it is a short-term problem, which I think is actually being solved right now.
Thank you for that view. So I think I see the time is running a bit, and I think inflation is certainly a very, very important topic, and all the elements which play in. But I don't want to miss it as well to talk maybe two other things, and also there I see a question from the audience when it comes to China. China is something which it's maybe a bit a contradiction to that what we heard about with the interest rates and so on, since they're rather the policy is towards a bit lower interest rate actually, but nevertheless. So when we talk about China, and as well now this kind of policy when it comes to zero COVID tolerance and so on, when we take that as well into our mind, and we know that China is very important as well for the industry in the region where we are here in Southeast Asia. So how do you see the actual situation, and how worried do we have to be about the recent developments on that part of the world when it comes to property and other topics?
Maybe I can kick this one off. I mean, we discuss this almost every day, and as a matter of fact, our clients who are also entrepreneurs, like many of you here also in a SwissCham are, right? They're extremely worried, right? So the zero COVID, right now you have a virus strain that is much higher transmission rate. So right, and you still have the zero COVID policy. So how many more lockdowns, tough lockdowns are we gonna see? And it is something that none of us probably has the ultimate answer to. We have a bit of a theory, and it goes beyond, right? Olympics, of course, they don't want any things to happen during that. Even afterwards, we're not convinced they're going to wholesale really open the economies. It's probably difficult for them. But what we do believe, and China, of course, has the has a particular setup where you do not have a public debate, and then we know which way it's going to shift, right? These things are going to happen suddenly. We would not be surprised if we're starting to see a bit more of a, call it maybe Singapore model adoption, right? Where you say, okay, we accept it's there, right? And every time a wave happens, we lock down a little bit less than in the previous waves. So more people can get it, more people are vaccinated, the drugs are better and everything. We believe there is still a bit of a theory, I must admit, but that since otherwise it gets too expensive for China, and they lose potentially more share in the global supply chains, that the Singapore model is sort of more silently, maybe suddenly adopted, but it seems quite plausible from an economic point of view.
Mm-hmm. Maybe I can add just a few words on China. I basically agree with what you said. So the zero COVID is a big question mark. We don't know how long this will last, if China can make a shift to a different policy. So Rajeev also already mentioned, I think, the IMF forecast, and yesterday the IMF published the updates, and one of the remarkable things in that update was that the IMF has lowered the growth forecast for China for this year. And I think in my view, there are a number of factors that are likely to hold back the economic activity in the near future in China, and zero COVID is certainly one of them. So there's also, I think we should not forget, the leveraging in China's real estate sector is going on, and the private consumption looks, hasn't recovered that much yet. And as you mentioned, the pandemic-related disruptions are still there. And so far, whenever there is a COVID hotspot, they close the factories, they close the ports, and so on. As you said, big question is how will that develop this year or next year? And also the vaccine is apparently a problem, but at least that's what I read, is that their vaccine is not that powerful against Omicron. And for some reasons, they don't want to, or they don't have their own mRNA vaccine yet. And I think this is, to me, one of the downside risks for China. On the other hand, as Rajeev said, China is on a different path when it comes to monetary and fiscal policy. Last year, they were more on the restrictive side, and as opposed to the US, and this year it's the opposite. They are on the stimulative side, and increase their fiscal spending. They tell their banks to increase bank lending, and they also, as Rajeev mentioned, have cut the policy rates and increased the liquidity for the banking sector. I think this is, to me, a remarkable development, that we have this kind of divergence again. Now it's on the other side, and I think this is my take on the outlook for China.
Mm-hmm. Okay. So now I see we have some questions which I want to bring in. So two of them comes a bit with the growth. So it was, one is China. Now the question disappeared about the growth was even higher than predicted, or predicted from China itself. It was 8% and not 6%, and so was that by a surprise? And maybe as well when it comes to the ASEAN region, so what is the realistic GDP growth rate you see for ASEAN? Do you see consumption index decouples since the growth rate is boosted by service and government spending? So maybe that is as well a question going into that direction. Maybe if I may ask you, Mark, do you have any assumption on this GDP growth for the ASEAN region?
ASEAN pre-COVID was growing at about 5% per year, and I mean, you know, if COVID becomes endemic, et cetera, then I think it can go back to that. And the thing about ASEAN is that obviously it's a political entity that dates back to the 60s or 70s or something. I can't really remember, but each country really has very different dynamics. And so I would just say there are two that stand out to me as having particularly bright futures, which are Vietnam and Indonesia. And so I have a feeling that their growth trajectories will remain very strong. Every country is good at a few things. I mean, the Thais, for example, are probably the best in the world at tourism, or among the best in the world. So that, I think, will be another growth industry when they reopen their borders. And so is Singapore very good at finance? I don't want to ramble on, but I find it's an extremely interesting region. I also find it tends to get lost, fall off the radar screen, because even if it is a, you know, what is there, something like 600 plus million people in this part of the world, and even if it is growing at a very strong rate, because it's all cut in little different pieces, people just don't have the time to spend looking at each one. And so it doesn't get the same amount of attention that I think it deserves, actually, if it was, you know, all put together the way China or India are. Georg.
Mm-hmm. Rajeev, something to add on that?
I mean, I fully agree that that when things normalize post-COVID, we'll have a recovery. The region also is part of the global supply chains, Malaysia and semiconductors as well. When there's a demand which picks up, or as the demand is picking up and getting strong in Europe and the US, I think that'll all be very good for ASEAN. The part I'm a bit concerned about is that with the Fed hiking, central banks in the region are talking about increasing rates. Well, we just saw the tightening in monetary policy in Singapore, but we will see more tightening of monetary policy in the region as well. And that'll be a bit of a headwind, especially while waiting for tourism to reopen in countries which depend on it. But on the manufacturing side, I think ASEAN and the main countries which are exporting is really in a phase of recovery.
Very good, thank you. So when it comes to wealth management, so that means as well we have to have an opinion about how currencies develop, and so maybe there I want to address a question to Hartmut, since he is running wealth management researches as well. So what is your expectation on the Swiss franc against Singapore dollar conversion? No signs of weaker Swiss franc, or should stronger US dollar almost impact on a stronger Singapore dollar? So a question for you, Hartmut.
No. So we have, look, general topic, and I guess there's also broad agreement. Not sure that's always a good thing, but I think that's pretty much also in the position, and we can see that there is agreement on dollar strength pretty much across the board. That also includes versus the Swiss franc. So our year-end forecast is at 98. Yeah, so US dollar versus the Swiss franc. And you would expect. I mean, I guess Marco is actually the better person to speak to on this. I mean, our view is this: right? You have in this year you have two camps of central banks, right? Or let's say we consider the Fed in the middle. Yeah, so the Fed is already, as we know, probably ahead of multiple hikes now. And then we have very hawkish camp, or relatively hawkish camp. Who are they? I mean, certainly, New Zealand here in the region, we would count in that. A bit more also on the hawkish side, maybe Canada, right? They'll eventually come in. Bank of England, and then we have. Again, we may have different views on this, but anyway, our views is the DAFs who will be very, very slow to do anything is certainly Japan in our view, and is also the ECB, and with again, right, our colleagues at the SNB looking, of course, at the relation to the euro versus the franc. We think it doesn't look very likely that the SNB goes ahead in terms of any sort of tightening before the ECB does, and if the ECB is slow. That's sort of your relation why we think dollar. If you ask me for dollar Swiss franc, you see the advantage on the dollar. But I'm sure Marco is itching to also chime in here.
Yes, I'm very sorry, but this is definitely not the question I can answer. Yeah.
No, that's the reason. That's clear. That's a reason why I didn't address the question to you. I know central bankers don't like to be asked about the prediction of a currency or whatever. So absolutely clear.
Georg, maybe I could just butt in with another perspective on the franc. I'm a big bull on the Swiss franc. I think that the franc can really strengthen, during 2022. Against the euro and even against the dollar. I do feel that we have entered a different regime with the franc in inflation adjusted terms actually not looking all that strong anymore. After all, the SNB's done a fantastic job keeping inflation low in Switzerland compared to Germany, compared to Europe, compared to the US, compared to most countries, maybe except for Japan. So because Swiss inflation is so much lower than the rest of the world, it does allow the Swiss franc to strengthen. And I think we'll have a stronger franc. Now on the Singapore side, because the question was Singapore versus Swiss, Singapore is also wanting its currency to strengthen as well. So that's a positive. And if, as we had this discussion in ASEAN, if we're having a recovery in Asia as well, that's positive for the Singapore dollar, which is a basket of many currencies, including the Chinese yuan, as well as other currencies in the region. But net, I would still think that that Singapore dollar.
I didn't get the last sentence. Can you just say?
Oh, sorry. Net, I think that the Swiss franc will remain strong against the Singapore dollar.
Okay. And Swiss francs remaining strong, and that leads me to the last question. If there is not something else in the audience, which is very important, but I think it's remaining strong. Swiss franc means maybe as well a bit safe haven. So we see some developments in the world. We see as well this Ukraine-Russia situation, and maybe just as a last question to you, dear panelists, how do you see that situation? Do we have to be concerned? What would be maybe a scenario as well, which we need to consider when we look at the world map, actually? So how do you see that from an economical point of view? So I let it open to who wants to ask to answer first. I guess there's more than one answer.
I'll go first if that's okay. So I think the immediate impact would be on the energy prices, which are already hurting Europe. I just read the other day, the average European household spent, I think it was 1,200 euros or something like that. Actually, wait, I better not give you the numbers outright, but it was something like a 50% increase in their electricity bill in 2021 over 2020. And so they're already hurting. And so if it goes up more, because we know that most of the gas that comes into Europe is coming from Russia, then I know that this is a Swiss Chamber of Commerce event, but as a Canadian, let me just say, Canadian dollar.
Okay. Sure.
I am
Canadian
concerned
dollar
about the situation in Russia-Ukraine border. I think that if, in the terms of the scenarios you're asking for, Georg, I think you have a number of scenarios, some of them which would be quite hostile towards Ukraine, and some which would be more disruptive. More hostile ones, such as an invasion, a coup d'etat in Kiev, or an occupation or a separation of the Donbass, would create sanctions, would cause sanctions to be ratcheted up quite significantly. And there I fully agree with Mark, higher oil prices, but also a geopolitical shock for Europe, and that would be quite negative. So I do think it is something very important and concerning from an economic and financial perspective.
All right. Some further comments maybe on that? Otherwise, 1 hour is already gone, and I want to come to the conclusion a little bit. So I think when it is not a so clear picture which we have now with all these topics. It looks like the situation looks a bit complex for 2022. Inflation, I think, remains a topic based on all these comments which we heard. So there will be a couple of influence factor which will remain us busy on that topic. I think it's not that it's already clear that inflation is under control again. So I think we will have to live with that. Certainly, the good thing is that obviously with all the data and facts we have today is that we are in a good region. ASEAN region is a good one, and the outlook is pretty okay. Nevertheless, I think it's also one of the things which I take is that we will remain a bit risk off and all about. So there are some risk factors: energy prices, oil prices. COVID is not over. What does it really mean for and the value streams and the supply chains. We have some geopolitical situation. We have China, so that means that we will stay a bit in a risk-off mode, maybe as well when it comes to investments. Strong currencies like Canada dollar or Swiss francs and so on will probably stay important. And it's not that everything will be very easy. However, when it comes to investment market, we heard as well that it's not a reason that we now have to sell all our equities or so on, but maybe be a bit more prudent and a bit more selective what is investable and what will be maybe a bit more difficult in future. But therefore, we have a lot of experts, and these experts are here today on the panel, but they're also here during the year with their institutes and doing a great job when it comes to predict, but as well manage investments and so on. And with that, I want to thank you very much, dear panelists. For this active discussion. We couldn't touch all the topics which we discussed a bit for the preparation, but it's just I think it was a very lively and a good discussion. Also some questions from the audience. Thank you very much, dear members, as well for being here, for participating, and I wish you all a very successful 2022. And in the mode of Hartmut, I think you can have the final words to wish a happy Chinese New Year. I think you have to dress already.
Yeah, okay. So 祝大家身体健康，投资顺利。Yeah, happy, healthy Chinese New Year and happy investing and stay safe.
Thank you. And with that, back to you, Carissa. Thank you very much.
Thank you everyone for attending the webinar, and see you soon.